Hi, I'm Michael Kennedy from Capital Focused. We're making this short video today to help our clients understand and get through some of the market volatility that we've seen over the last month. The size of the drop has been significant. It's been one of the biggest drops since 2008. However, share markets prior to that were up 30%. So yes, we've seen 20% drop. However, for most of our clients, a year in, there's probably still around positive returns. So we need to remember that markets do this regularly. It's been many hundreds of years that the share market's operated because it's not something made up. It's a real thing. It's the value of big companies, of CSL, Visa, MasterCard, and the price sold in exchange between people, and that's what the price represents. We're worried about COVID-19 for our personal sake, for the point of view of medical. From a long-term point of view, investing right now makes sense. This is the point in time where we really get down to earning our keep, to showing you what we do well, to proving that your retirement is safe. And as we take you through over the next few weeks and we keep you updated and we keep telling you about how your investments are performing and what we're planning to do to keep you on track, to make sure that you're there for the recovery, which has happened every single time. There has never been a point in history where it has not recovered. And as we build back and we find opportunities and we make sure that your portfolio is well positioned to take advantage of those, that's our job. You're going to see a lot of news. You're going to see a number of events come out about Italy, about the US and Europe. There will be the word recession comes up at some point. And when you see that word, you go, right, does that mean that the entire world has finished? Or is it like every other virus that's come out, like SARS, like MERS, like Spanish flu, like all these words that sound very scary, but the world went on. And as investors, as allocators of your capital, your money is where ours is. We are investing that money to make sure that your retirement is assured, and our investment strategies are well proven, scientifically researched, and audited to make sure that they are the best possible strategies that we can put together, and our clients for many years have seen that protect them. We're looking forward to helping you both now and in the future, and if you've got any questions at all, please send them through, but we're confident that the strategies we're employing are the right ones to set up your retirement. So when we look inside of our clients' portfolios, we make sure that there's a variety of assets, including US dollar cash. We do that by using fund managers like Magellan and other fund managers who make sure that inside their accounts, they hold cash internally. Those funds are held in US dollars, and as the Australian dollar drops, the value of their Australian money goes up effectively. So holding foreign currency does help, and that's what we've already been doing to help protect our clients' portfolios. We hold currency for clients in US dollars, and our overseas shares are held in foreign currencies. So as the Australian dollar has been dropping, that's protecting our clients from the market because they get the upside of their value of their investments going up as the currency is dropping. So yes, we hold US cash. The fund managers we use do that inside their accounts, and equities are held in US dollars. That helps protect clients from that. When the Australian dollar drops, Australian businesses become more competitive. BHP, Rio, CSL, Newcrest, all those big companies, they sell to the world market. Collectively, Australia is getting the benefit from a lower currency. Many other countries around the world would love to have the shock absorber of a falling currency. This is going to protect Australians from the impact of COVID-19 to say we'll be okay because our currency will buffer us from the change. So one of the most fascinating parts of interest rate policy, which in itself sounds dull, is that as interest rates go down, the value of equities in relative terms actually goes up. So equities will be protected from it. It also means though that people who have cash and term deposits realistically don't have a lot of choices about using those for long-term investing. And they'll end up having to buy equities or property to make sure that they've got something that makes a reasonable rate of return. So we see low interest rates as positive to asset prices. However, to those who've got lots of cash deposits, it's probably a time where they have to look at what they do to mobilise, because investors are effectively almost instructed to move money out of deposits into shares or something that makes a positive rate of return. So we see it as a positive for clients who take a long-term view. One of the impacts, though, of negative interest rates is that banks suffer from that. So when we consider about what's possible with investing, we know that banks make a margin between what they give you as a customer and what they charge out in deposits. And if that margin gets smaller and smaller, we see the value of bank shares coming under a fair bit of heat. And we'll see this around the world. In our view, the way that we look at active management is we'd prefer to hold different companies perhaps than the banks to make sure that we're protected from that. So our active strategies protect clients from negative interest rates, but overall low interest rates should support higher asset prices in equities. So when we're looking at the timing of starting retirement, so for clients who are considering whether or not now is the right time to retire, we still think the answer is yes. The reason for that is that when we construct investment portfolios, we use buckets. We use buckets of money for the first few years and the next few years and the years afterwards. And we see while the impacts of COVID-19 have been quite significant on equity markets, it hasn't changed our long-term view that if you can achieve a good rate of return with enough capital, your retirement today will not change based on what's occurred over the last couple of weeks. The long-term view is stay the course. If you're retired now, stay retired. If you're considering retirement, still consider retirement. The timing has not changed based on this equity market sell-off. What's really changed is perhaps how often you book a trip to Europe this week with the flight bans occurring. Ultimately, your ability to retire will not be changed by what's occurring through equity markets at present. History has shown us for years that selling after a crash has not been any better off than staying the course. This is a process of taking active investment strategies which we employ to protect and grow our clients' wealth, and we're seeking to find the opportunities in this sell-off of assets that have still got great quality that may be at stock take sale prices. And in that, we're focusing on finding the next winner. Perhaps last week was more expensive than this week, but next year or 5 years from now will be impressively bigger than where it is now. And that's how we do it here at Capital Focused. When we're looking at investing, the adage of buy low, sell high stays true. Presently, we're in the middle of that. We're looking for opportunities. We're looking for areas we can deploy cash, where we can change to take advantage of what's occurring and make sure that our clients' retirements are well set up for their entire retirement. So if I had $1 million in cash today, would I invest it? Yes, in bits and drabs as we see the volatility come through. Presently, we have client cash that we're allocating and buying into equities today. We are selectively buying the value buys. We're finding the bits that are on special, on sale, that will always need those dividends, will always need that growth. So yes, if I had cash today, I would be buying. I'd be buying in bits and pieces as the markets see that there was great opportunities. And that's what we still hold to be true. When we're looking at deploying fresh money right now and taking advantage of these opportunities, we want to buy in a process of finding the best buys. And in the middle of some of the turmoil, these opportunities present themselves perhaps only for a fleeting day, because for some reason that somebody pressed sell at the point, and we found an opportunity for a client to go, wow, that's incredibly cheap. Let's buy some of those up. So we're actively looking through the market to see what's great, what we'd buy today for ourselves and for our clients to make sure that they will be able to take advantage of that. And that's why we employ active fund managers. Their job is to be doing the same thing. We're looking together, we're working with you, and our money is the same as your money when it comes to this investing process. Where our money is, your money is. People find that the non-stop 24-hour, 7-day-a-week news coverage of this event is so consuming that the anxiety that's created by the idea of a virus, a concern, a flu, the world needs to stop, is so significant that it's hard not to buy more toilet paper. We can't really, though, ever think that the entire world will stop. When we drive our cars to work, when we buy the groceries, when we literally go to the doctor and buy medicine, all of those components come from a company. And those companies might now be on sale. However, we're still buying their same goods and pieces. So when people consider the panic of what's going through, we see the opportunity of what could be in the middle of that. If I was investing right now today, I would still be allocating to the same portfolio, buying the same assets. I'd be buying them at 20% less than what they were a month ago and going, this is pretty good. The fundamentals of what was there a month ago have not changed. Great companies are now cheaper and we can buy a few more of them than we could before. It's still a good time to invest. When we're constructing client portfolios, we build them for the client in mind. We'll take defensive strategies for clients who need more defensive investments. And we're finding even defensive investments have some amazing opportunities. When we're building that portfolio, it's in light of our clients' needs and circumstances. So I've been advising clients in equities since 2002. So it's about 18 years of doing this. We've seen the 2002, 2003 tech crash. We've seen the 07, 08. Going through all of those time zones, what we know about those is that there will be another sunrise tomorrow. Staying the course and being convicted that you know that the investments you're using are the best quality ones you can possibly use allows you to take confidence that your retirement is assured. When I think about what happened in the 2008 event, equity markets dropped from 14,000 to 6,000, which was significant. They then went up to 25,000 within 10 years. So had you sold at the bottom of that process, you would never have seen the 4 times rise of your capital to get back to where that was. So what we would say with clients is that stay the course. We're not panicking. We're taking measured approaches to find value and find opportunities. And in that, we know that with our clients' best interests in mind, we'll work with you to make sure you're comfortable with what your portfolio does, as we're doing the same thing with our funds, our parents' funds, and all of our clients at once. The very nature of investing is that it is cyclical. Over the last 118 years, that's a long time frame, it's gone up and down. On average, every month it goes up, the next month it'll probably go down. However, the magnitude of the up, thankfully, is bigger than the down. And over that time, so over 118 years, it's made in order of 7 to 10% across all the events, across every single time frame. So when we think about why we still invest, it's own great companies that do good things in the future, make sure we're active, make sure we're passionate about investing, and make sure that those investments that we're using are well set up for our clients' projected lifetimes. And doing that, we know that the cyclicality of it will be seen through and our clients will be protected. The insurances that we've set up for clients, those insurances apply for COVID-19 because it's an illness. Worldwide coverage 24/7, those insurances are full encompassing. There are no restrictions or limitations that the insurance companies have that says that was from a particular pandemic or epidemic. This virus has a very low mortality rate for those who are healthy and well and younger. As they get older and perhaps have other issues, as we've found in China, those have affected some people. However, globally, what we've found is that there's still not a lot of healthy people who've been affected at a sick level of this event. We hope that that continues to be the case, but if it's not, insurance companies are still required to fund any insurance payouts with regards to COVID-19. So income protection will still pay out for all events, from COVID-19 to toilet paper rushes in the supermarket, all of those events, your tins of canned food falling on top of you from protecting yourself from COVID-19. You are still protected through your insurances. They don't have a way of getting out of that from you. Keep your cover. It works. Thank you to all the clients who've come back saying they don't have any questions. They're putting the trust in our team. We say to you, we're here. If you get concerned, email us. If you've got anything, text me, call. We're here. We're looking to make sure that everything we can do to ensure that your retirement's sorted is what we get paid to do. Please make sure that when you're talking about these stories with family and friends, if they've got concerns, feel free to forward this video to them to understand that they'll be okay as well. So the true value of advice is in these times where you as a client are feeling anxious, when you're feeling a bit stressed. And when we take that trust and we respect the trust that you give us, this is the time when you can rely on us to protect you, to make sure that the decisions that are made are savvy. This is where we earn our keep. Keep in touch with us. If there's concerns that you have, we'll be in touch. You'll be in touch. We are here for you.